It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money show. We are so happy that you are joining us today. It is the last weekend in April. It has just been, it's too cold for me in April. I mean, thank goodness. This is like one of those weird months where you get the little tease of like, oh, it's going to be warm again. And then you look back and say, oh, I wish I took advantage of the fact that it was like actually cool and lovely in April since it's 90 degrees and, 80% humidity in the summer. I know. But alas, alack, this is what seasons are all about. This is the season where you're going to do some financial thinking. And that is why we are very happy that you are joining us. If you have a financial question, and I mean any financial question, send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. And that will allow you to get two sets of eyes on your financial situation. Mine and excellent executive producer extraordinaire, Mark. We're both certified financial planners. And so we don't have a business anymore, but we have that kind of, mindset, let's call it, that we think broad and we try to take your questions and we answer them. The fact that we're CFPs, we're going to talk a lot more about that next hour, because we are going to be joined by a certified financial planner who is in practice, a practitioner. His name is Brent Weiss, and he is coming on the air from Facet Wealth. And Facet Wealth happens to be the sponsor of this show. And so we bring him on the air. We want to hear what's going on the ground, what's happening in real financial planning 101 out there. Facet Wealth is a company that is trying to create financial planning opportunities for a broad spectrum of people. They say they're accessible to everyone, conflict-free planning. And it all comes from certified financial planners who are fiduciaries. We're going to talk more about those fiduciaries later. Goal-based financial planning from dedicated advisors. That's what Facet does. So if you want to check them out, go to facetwealth.com. All right, Mark, time for me I got the business done. The intro's done. Let's do a question. Joyce writes, she wants to switch to a 15-year mortgage, but the new rate only lowers the payment by $60. The rate differential is 1.2%. Closing costs are not that bad. Listen, guys, by the way, it's not the payment that you're shaving time off. So the fact that the payment went down and you're going basically from a 30-year mortgage to a 15, this is really interesting. So anyway, let's continue. Closing costs, not bad, $2,000, but many months to make it up. Should we just make additional principal payments each month or put more money from our savings against the refinance? Let's find out. Joyce says, I'm 65, my husband's 70. We're 5 years into our 30-year mortgage and it's a vacation home. Our income is fixed via Social Security and pension, but it is up $1,500 a month since the initial loan. So we've been making extra payments when we have money to spare. Agree with reluctance with inside dining despite being vaccinated. Thanks, Joyce. Okay, so, why are we paying this down right now? I want to know more about you guys. How much money do you have? I don't like the idea of putting more money down towards a refi. I don't want you to sop up any available liquidity, money that's around. You want that, especially as you get older. So I don't want to do that. Does it really matter do you really need to refi? Maybe you just make extra payments. Mark, is there a downside to just making those extra payments and not doing a full refinance? Well, that's a good question. Mark wants to know, is the extra money that you're putting down on this loan, can you knock off 10 years? Because you say you're 5 years into your 30-year mortgage. I guess the question is, can you be disciplined enough to put enough money down on this mortgage to shave off the time and pay it off in 15 years? That's the question. If you don't think that, it's not that big a deal to me. If you're going to keep this home, it's really your vacation home, you're not going to sell it anytime soon, and you're going to get the money back for the cost of the refi in the matter of, forget about like money months, let's just say it's 2 years and you're going to keep it for 10 years, then the issue is you'd have to be so disciplined to pay enough down on that mortgage on the home to get it done in another, by the time 15 years is up. So if you don't think you have that in you, then I would say, nah, I would actually do the, I would actually just do the refi. I don't think there's a huge downside except for the cost. So no new money towards it though. Really, absolutely, positively. I don't want any of your savings going towards a refi unless you're going to get back to me and tell me you've got, $4 million sitting in an account burning a hole in your pocket. Okay, here is another real estate question. This is from Joanne, who says, my mother-in-law will receive about $150,000 from a home sale. She's 88 years old. She lives in an assisted living facility. My father-in-law recently passed, so the property is transferred to her. Okay, good. She will be able to pay for her monthly bill of the facility except for $500 a month. My husband wants to invest the majority of the money in the stock market. I gasped. I suggested he would probably need to leave at least $10,000 in a money market or in the bank for an unexpected situation. He also mentioned putting a small amount in short-term bonds. What do you think? I have a very similar situation with my own mother-in-law, and I'll tell you something, I keep a lot more money in cash than that. So I always like to have 2 years of whatever I think I need in a boring account. So that 500, so you need to have at least, forget about 10,000, 12,000 is what I would have. I would probably have 15,000 in the bank, and I would probably even keep an extra, say 20 in a very low risk, maybe a higher yielding money market account. Who knows what she's going to need? What happens if mom were to get sick? What's the next level of care that might be needed? Do you think you might have to pay for extra help if something were to happen to her? These are all questions you ask when you start thinking about what to do with this $150,000. So what I'd like to also know is, what else does she have? Is this the only money in the world? If that's the case, I would make this a super conservative investment account. I mean, super conservative. Maybe, I don't know, at most I'd have 30% in stocks. I would not have more than that. Mark, is that too wimpy? In my mind, believe that more risk is not going to help her, and it's not going to really change her life. And therefore, I think that you taking on additional risk just puts you guys in a situation where things could go south fast. So I would if your husband wants to talk to me, I invite him to get on the line with us, really, because I just think this should be a portfolio that's really carefully managed. It should be cash heavy, and really an abundance of caution when people are at that stage in their lives. I had a mother-in-law who at age 90 was living in her own 5-bedroom house by herself, and very quickly things changed. So I just want everyone to know that's why we sort of try to keep it more conservative, because you don't know. All right, you're listening to Jill on Money. When we return, we're going to answer more of your questions. In the meantime, go to our website, jillonmoney.com. If you've got a question while you're there, maybe you're signing up for our free weekly newsletter, just hit the contact button and we'll get your question. Don't forget to tell us if you want to come on the air with us live. We'd love to have you. All right, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are here to answer your financial questions. Send us an email, askjill@jillonmoney.com, and let us know if you want to come on the air with us. That is what Jennifer did. Jennifer's on the line from Atlanta. Hi, Jennifer. What can we do for you?
My primary question is where we should be, my husband and I should be investing additional funds. Our circumstances did change. My husband got laid off from his job on January 4th this year. Thankfully, he has gotten reemployed very quickly and started a new job just 2 weeks ago.
Holy smokes. Let me ask you something. How did he get reemployed so quickly? What happened? Is he like a programmer or something? Like, is he in high demand? What does he do?
He is a project manager for audiovisual, and he just has wonderful contacts, and he has a great reputation in his field. And within a few weeks, he had leads, and he started talking to people, and is already reemployed. And he's loving his new position. So it's great.
Oh, that's so great! Congratulations to him. So that's fantastic. So,
Yes.
How old are you guys?
I am 48. He is 50.
Okay. Do you have kids?
He has 2 grown sons that we are not supporting.
Oh, my favorite kind of grown individuals. That's fantastic. In his new job, how much is he earning?
82.
You work as well. So tell me how much you earn.
146.
A little bit about more details about real life stuff. Home, do you own a home?
We do. We have a home that we just refinanced within the last year. It's worth about $400. We owe $260. It has now a 20-year mortgage at 2.75.
Oh my God. Isn't it amazing to look at those interest rates? Just to say that out loud. 20-year at 2.75. Fantastic.
Yeah, we couldn't pass it up.
No, I agree. Tell me a little bit about how you've been managing your retirement assets. So on your 146,000, do you max out your retirement contribution?
Yes, I have a work 403B that I max out with a TSP. So that's getting $19,500 a year plus some matching funds from work. They match 5%. We have additional funds with a financial advisor who's done really well for us. But he, of course, charges 1% of fees under management. Mm-hmm. So I don't know whether additional funds should go to him or whether I should put additional funds into my husband's 401k.
How much money does he manage for you, the financial advisor?
He has for us... in IRAs, we've got 272, a Roth, he's got 225, and some taxable brokerage accounts of 180.
That IRA, that 272, is that from your husband's old retirement account?
Those are old retirement accounts from him and from myself, yes.
Okay. Is he eligible for a 401k in his new job?
He is, but they won't let him contribute to it, and they won't match to it until he's been there 6 months, so not till August.
All right. Well, that's around the corner, basically. And he's 50, so he could put more money away. What else is going on that I should know about? Any weird debt that's floating around or any rental properties, anything like that?
We have no debt other than the mortgage. Credit cards and cars are all paid off. Mm-hmm. We do have our basement we rent out as an Airbnb. So that almost fully covers our mortgage, and it has been solidly booked for 2.5 years now.
What? Wait a minute.
Amazing,
I got to hear
right?
about this. Hold on a second. So it has a separate entrance?
It does. It has a separate entrance, separate driveway.
You Airbnb this. Even though you make a bunch of money, you guys are totally great. I mean, how much money's in your 403B right now, total?
About almost 200.
I mean, you've got all these assets. What made you think about the Airbnb thing?
My sister-in-law brought it up, and I thought, why would anybody want to rent out our basement in the suburbs? I never thought it was going to rent. So we started it, and we had a probably 6 months worth of kind of intermittent folks coming for the weekend. Mm-hmm. And then the current tenant has been with us 2.5 years, and he didn't want to sell his home where he lives. So he comes down here for work and stays with us. And he's literally been renting our basement for 2.5 years.
So what is that like, having a stranger right there? Do you see him? Like, how does that work?
We do see him on occasionally. We see him when he comes and goes. He's been here long enough that we know him and his wife very well now. They bring their dog, and we hang out on the deck sometimes, and our dogs all play. So it's been really wonderful. When we've had short-term tenants in the past, sometimes we see them, sometimes we don't. Since they have their own entry, we can close ourselves off from them completely. So
that's awesome. Well, good for you. I totally wouldn't do that because I'm just a weird about those things. I actually feel kind of jealous that you are the kind of, because you basically are now living expense free in your house, right?
Almost, yeah.
God. Okay. How much money do you think you have to invest at this point? Now, presuming that your husband has the ability to put money into that retirement account, come August. But what do you think is available on a monthly basis?
I'm thinking around $5,000 a month.
Wow. You like this dude, right?
I do. And he just sent me an update from last year and said last year our accounts were up by 12%. And so far this year, they're up by 4.5%. And I don't know whether my husband's new 401k is going to be Roth eligible or not. His old 401k, his old job was all Roth contributions, but All they've told us about the new 401k is that it's going to be held at the principal and managed by Wells Fargo.
Okay, well, now that you tell me that, I can almost guarantee that it's going to be a terrible plan because they have essentially, first of all, Wells Fargo, oh my God, and principal. It's basically an annuity contract inside of a retirement account. So it's probably going to be fairly high fees. So here's what I think. If there's a Roth option, then he should max it out. Okay. And then you'll let us know when you get the options, the actual choices inside. Then we'll have to go through the options and find the cheapest fund, which is obviously going to be just an index fund. But because it's a gosh darn annuity and it's managed by Wells Fargo, I can almost bet that that's going to be like, oh, it's an index fund and it's like a 0.5% fee instead of zero. But if there's a Roth option, we want to use it. And if there's a match, we want to see if that's eligible. If not, you like the financial advisor? I don't know. I feel bad. You could totally do it yourself. You could open up an account. I mean, you could reduce your fees just by saying, well, let me just take my old retirement accounts and roll it into, some other place and do it yourself. But you like the person. I hate to tell you to go elsewhere if you like the advisor,
I'm just very wary of fees because obviously I know that's going to cut into our long-term money. So
yeah, well, just know that you start every year at minus 1%. Does the advisor do anything else but manage money for you?
Yes, he is full service. He looks at your future planning. He gives advice on everything. He talks about when we're going to be eligible to retire and how monies are looking, et cetera. We would ideally both like to retire in our early 60s. I'll have a pension coming from my job. So that'll be nice. Obviously, the longer I work, the bigger my pension grows.
Yes, I love that. Look, I mean, you'll save the 1%, and sometimes that 1% is just like a little bit for you might be a peace of mind cost. So I don't want to tell you to not do that. I come from that world. I used to be 100 years ago a financial advisor who would charge 1%. And I remember having clients like you who would be perfectly capable of managing their own money who would still hire me. And why would they do that? They would do that because they said, well, you know what? I don't want to think about it. And it's a luxury and I'm happy to do it. And so if you feel that way, like you're getting value, this guy's doing full financial planning, it's customized. He's not hosing you, by the way, because, frankly, with less than $1 million under management, 1% is pretty cheap, relatively speaking. I don't think that this is a bad thing. I do think we need more information about hubby's new retirement account. And maybe I'm wrong. Maybe all of a sudden the principal and Wells Fargo have very cheap options inside. I would be delighted if that's the case.
But if they have a Roth option, max it out, even if the fees are a little bit higher.
Yes.
Up to his full 19.5 plus whatever his over 50.
Wait a minute. It's 19.5 plus he's 50. He gets to put in an extra 6,500. So he gets to pop some real money in there. And it definitely, if there's a Roth option, I would absolutely do it.
And if no Roth option, put in the minimum to get the match and then give the rest to the advisor.
I think so. Unless we look at this and say, oh my God, the cost is much better than we thought. I mean, look, it could be that all in on that retirement account, it's more than 1%. That's why I'm thinking that maybe you just go to the advisor. In other words, there's a cost of the actual plan. Essentially, it could be that, it's a 1.5% a year for him to use that plan. And then all of a sudden that maybe the 1% is better for you. So let's see what that plan is, and then we can make better determination. Sound like a good deal?
Sounds great.
If you want to join us, just like Jennifer did, all you need to do is send us an email or contact us from the website and say, hey, I've got this question and I want to come on the air live with you. It's Jill on Money. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. And boy, I love answering these questions with you guys. Keep them coming. Send us an email, askjill@jillonmoney.com, or hit the contact button on our website. Come on the air. Do it. You can do it and be just like Devin. Devin's on the line from Washington State. What can we do for you?
So, my main kind of predicament that I'm looking to get out of is I put money into an IRA last year and a Roth IRA. And I actually made gains on the money that was in the IRA. And now I don't know how to kind of legally take that out without getting
Hold on a second. How much money into an IRA, a traditional IRA last year?
I put $6,000 into a traditional.
Yes.
And I think I put about $1,500 or so into the Roth.
Whoops.
Yep, exactly.
Whoopsie. How much money did you earn last year, 2020?
$173,000.
Are you single or married?
Single.
It's funny because you were not allowed to make a Roth contribution at all. So that's number one.
Yeah, and yes.
Did you file taxes yet or not?
I have not because of this.
Thank God. Thank God. Okay. Then we're going to undo this.
Okay.
We're going to totally undo this. Where did you make these contributions? At a big brokerage house or a mutual fund company?
Brokerage house, yes.
This is what you're going to do. You're going to contact the brokerage house and you're going to say to them, whoops, I made a Roth contribution and I shouldn't have. And you're going to ask them to undo that for you. AKA recharacterize is what it's called. And you're going to say to them, I screwed up. I'm so sorry. And they'll figure it out. Now, the IRA had $4,000 in it. Had you taken a tax deduction for that $4,000 that was in the in the existing IRA?
Yes.
Oh, criminy. Okay. You're also going to tell your brokerage house that you made another boo-boo. You're going to say, oh my gosh, I made too much money to actually commingle this with a deductible IRA. I think he should try to separate it now before it gets messier. We're only 1 year into it. In other words, I think you can say to the broker, so Mark's asking, hold on a second, Mark. So let's just say that he's got $4,000 of a deductible IRA. He's got the $6,000 that would be a non-deductible IRA. Because what you're suggesting is we have to recharacterize the account to make it essentially a non-deductible IRA, and then you want to convert the first $4,000, which I get. But the problem is they still have to separate it, don't they? They have to. In other words, I think it's going to be harder to do unless you separate it. All right, so here's what we're going to do. Mark and I are fighting about this. So what we think you should do is, first of all, the easiest thing is undo the Roth. The second thing is you're going to talk to the brokerage house and you're going to say, I screwed this up. And here's why. Because the original $4,000 that went into that IRA, I took a deduction for that. And were you entitled to that deduction? That's one other question. How much did you make was that from 2019 or earlier?
That was from 2019. I think I made 123.
Oh, this is actually better. Okay. Let me rephrase this. Okay. So what you have to do is you say to them, all the money that's in this IRA should be recharacterized as a non-deductible IRA. I was never entitled to take my deduction for 2019. The whole account has to be recharacterized. It's a non-deductible IRA. Now, here's the other pain in the ass. When you file this year, your 2020 returns,
yes,
you're going to have to also amend your 2019 return because you are not entitled to take a tax deduction on that $4,000.
Okay, that's because I made too much?
Correct.
Okay, and what's the threshold?
So in 2019, single, the most you could have made to take a deduction is $74,000.
Oops.
Yeah. So you're just off by $100,000. So that's really critical. And the thing for a Roth IRA, like for now, for this year even, single, you can only make a Roth IRA contribution if you make less than $140,000. But you can do backdoor Roths. So what you would want to do is you want to recharacterize this whole $10,000 account. It's going to be a non-deductible IRA. And then you're going to immediately make it a Roth IRA. You're going to actually turn it into a Roth after this is all done. So wait, do you have a retirement plan at work?
I have a 457.
How much are you putting in there?
I've fulfilled it the last 3 years, so 19.5.
Okay. How old are you?
30.
So here's the way that this the idea of a backdoor Roth is. It's like, hey, I'm Devin, I'm 30 years old. I make too much money to make a Roth contribution, right? And I make too much money to make a deductible IRA contribution. So I am limited. I can put $6,000 into a non-deductible IRA. Then as soon as I do that, I can now turn that into a Roth IRA. That is what a backdoor is all about. You can put the money in, but then immediately you turn the switch on and you can actually turn that into Roth money.
Okay, I've read about it. How do you turn the switch on? I guess I'm confused about that part.
When you have the $10,000 IRA account, you're going to recharacterize that and it will be turned into a non-deductible IRA. That's the most important thing. Then as soon as you do that, you can convert that. You talk to the brokerage house. You say, and now what I want to do is I want to open a Roth IRA. They may even let you keep that existing account that you have the dumb $1,500 in, but you may have to close everything out and start over. And then you want to immediately convert the $10,000 into a Roth IRA. That's it. They'll do the work for you. They know how to do the backdoor conversions. Right. You're going to have to pay the tax that's due on whatever the accumulation has been. Okay.
And I can do that. So I can do that every year. I can put the 6 in a non-deductible IRA and just instantly call them up and say, hey, I'd like to transfer convert it to the Roth.
Okay, so Mark says this may even be able to be done just quickly online because a lot of the large houses allow you to do that. They say, you make the money, now do you want to convert this? Yes, click, go. Now, it should work for you. But again, it's methodical, right? So it's this IRA with the 10 grand has to immediately turn into a non-deductible IRA. There may be some taxes to pay in doing that. And then the conversion to the Roth that's your first. So it's recharacterize, non-deductible, then to a Roth.
Perfect.
Do you notice that when we're on the air live with you that we uncover different things? It's so great. So when you have a financial question, an investment question, an estate question, whatever it is, ask Jill at jillonmoney.com. That is the email address. Our website is jillonmoney.com. Let us know what the question is, and we will get you on the air. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money, and we are here to try to take the mystery out of your financial life. And you know, for a lot of people, it's been such a crazy 14 months. I don't want anyone to make a judgment here. Some people have suffered disproportionately. Others have done okay. Regardless, you might have questions about your own financial condition, your life. Maybe you're at a crossroads. Maybe it's a career question. We'd love to hear from you. And we really encourage you to just send off that note, whatever it is that's on your mind. It's almost like you want to take the pressure off yourself. You want to say, I'm going to stop making myself crazy or worried about these issues. And maybe it's taking up too much time and energy in your life. Why not put it on us? We're happy to worry about it for you. And we'll give you our best analysis of whatever the situation is. So send us an email. It's askjill@jillonmoney.com. Askjill@jillonmoney.com. And by the way, we are presented by LifeLock. LifeLock, let us help protect your identity. So keep an eye on that identity, especially tax season. You know, the scammers are out. So be careful. Get the shredder. Don't be nuts. Don't share your information. I really think that the digital security is so much better than what you think you're getting when you have physical stuff out there. So embrace it. Come aboard. We're in a new society here. And I know it's a little scary, but let's get you on board. All right. Sue writes that she is 62 years old. Her husband is 73. They're debt-free. She says, I'm in good shape to retire between now and age 65. We live in our income streams and saved money. That's great. Okay. we're contemplating moving an hour away to live closer to my son and his family as we age. We would go into a 55 plus community, similar to the one we live in now, that is located near his home. We're considering using a reverse mortgage to obtain the new home for two reasons. One, we can unlock about $100,000 of equity in our current home and be able to invest it when we sell this home and use the remainder of the money from the sale of this home to fund the cash needed to take out the reverse mortgage. Two, we would be able to afford a little bit bigger home that would give us much needed space so we could have more space for our family and exercise equipment that takes about up a third of our space in our small house. And I'm tired of tripping over my total gym with a big, huge smiley face. For the reverse mortgage, I am told, should the new house not appreciate as indicated, and when we either die or sell, we're in negative amortization series, mortgage. What would your advice be on taking out a reverse mortgage in this situation is this? We'd really love to have $100,000 more liquid to invest rather than have that equity tied up in the house. Okay. I don't think this is a good idea. Mark, do you have a visceral reaction? I'll tell you the reason why I don't think it's a good idea. It's a horrible idea, says Mark. I said, I don't think I was trying to be nice because I got a better night's sleep than last week, so I was in a better mood, and I wasn't so cranky. Mark didn't get as good a night's sleep, and he's a terrible idea. First of all, just sell the house. Sell your house and take the money. There's you are. You can unlock all the equity immediately. And if you want to have more space and you want to spend a little more on a home, then let's run those numbers. But why would we get you involved in a reverse mortgage to do something that's really a simple transaction? And I'm very wary of getting yourselves in a situation where you have any sort of ongoing liability. And it just doesn't make sense to me. So let's just go and do the simple thing. I'm going to sell my house, and let's just pretend you say, oh, okay, I'll get $200,000, but I have to spend $250 to get something I really want. Okay, let's see if you can do that. Let's see what, you say you've got your income streams and you've got saved money. How much money is saved? Maybe we can make this all work for you. No reverse mortgage. This seems like a very complicated solution to a simple question, which is we want to buy a new place and the new place is going to cost more than the old place. That's it. And that's it. So if you want to feel like, in terms of how you want to have more equity in your house, then what you can do is you can say, sell your house, put some money down on the new place, get a mortgage, which, by the way, amazingly, you would probably qualify for a mortgage because you have income, and move on. And that's it. These reverse mortgages are still kind of thorny to me. Mark, I never forget Sandy Jolly. That interview has stuck with me. I know that the reverse mortgage market has certainly gotten better, but holy smokes, it can be really dangerous. It can be a problem when it comes to the surviving beneficiaries of this property. I don't know. I just don't get involved. Yeah, it seems like Mark says it's a whole lot of hoops to jump through to actually get a house. So we have when we have simple problems, we like simple solutions. And usually the simple one, keep it simple, stupid, as my first professor of options theory actually put on the board, KISS, keep it simple, stupid. It usually is the best solution. Okay, you're listening to Jill on Money. Ask us your simple or complicated questions, and we would be delighted to answer them. Send us an email. It's askjill@jillonmoney.com. Hop onto the website, sign up for our free weekly newsletter, and we'll be right back. You're back. It's Jill on Money. And Mark and I were just talking during the break about that last question. And Mark reminded me that that came from somebody who had checked in with us from the podcast. And we have a sister program. It's a podcast called, very easy to remember, Jill on Money. And if you've never listened to podcasts, I think you might be missing the boat. I love radio. It is my first love. There's no doubt. I love terrestrial radio. Mark and I are creatures of this medium, but just want to let you know that a podcast, you can listen to it whenever you want. So just think of it. It's like radio on demand. So if you want to check out our podcast, Jill on Money, you can get it wherever you get podcasts. If you don't know where that is, just hop onto our website, and right on the front door, we have a way to subscribe to it. Apple, Google, Stitcher, Spotify, anywhere you find your podcasts, just get it. Okay. Let's do a quick question before we go to our break here, which is from Brandon. Brandon writes, I'm 24. I listen to you on the radio. Oh, Brandon, you might be the youngest person listening to the radio. Fantastic. I'm looking to move out for the first time. I don't know if money-wise I'm ready to move out of state. Any tips or prep to make sure money-wise I am ready to make that move? Well, I'll tell you what. You got to know what you're going to pay in rent and utilities. You got to run the numbers. So have you been tracking that? Have you figured out where, the money goes every month? Do you have enough money in emergency reserve to take you through whatever comes up for you? This is why I call this my big three. So, if you have 6 to 12 months in the bank for living expenses, and you can manage that. And I'm not talking about living with your parents and like, oh, I give them $100 a month towards utilities. I mean, really run the numbers. Look at what the rent would be. Look at what your utilities would be. Look at what your income is and run these numbers. And if you've got a boatload of debt that's still outstanding, and maybe some of that is student loan debt, maybe you're not paying it because it's in forbearance right now, don't forget to factor that in. Run the numbers. I want you to have 6 months in the bank. And then you got to have money to make the move, to actually figure out how you're going to schlep your stuff out and go to a new place and get new furniture, all those things. We need to know more about you, Brandon, but we so appreciate your lovely note. All right, it's Jill on Money. When we return, we are going to have an interview with a real-life certified financial planner practitioner, someone in practice. Jill on Money will be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of Jill on Money, and we are broadcasting from the Capital One Bank virtual studios. Capital One, this is Banking Reimagined. What's in your wallet? People are so uptight about low interest rates, I have to say. Like, I never worry about this in terms of like their bank accounts. I worry about it in terms of portfolio management and, what bonds are yielding. But your emergency reserve fund, I know you wish you were making a little bit more money on your money, but, it's a security thing. Don't worry about it. Let's worry about the things you can control. All right. All right. It's hour number 2, and that means we have a guest. And our guest today is Brent Weiss. And you remember that he has this funky title called Chief Evangelist. Well, he's a certified financial planner, and he is a wonderful talking head from our sponsor, Facet Wealth. And I'll tell you more about Facet Wealth a little bit later in the interview. But what's important to know about Brent is he is here and joining us to celebrate Financial Literacy Month. How exciting. So here we go. Here is our interview with Brent Weiss. What do you think is the barrier to people really wrapping their arms around the financial concepts that they don't know? You think it's embarrassment? Like, that you've often, I'm sure, sitting with very wise people who are accomplished in their careers, and they'll say, okay, can you just explain bonds to me, dude? Like, what is it that what is it that prevents them from getting that information, do you think?
Yes, there's some of that. I'll say there's some shame in the fact that smart, successful people come in and they don't know how to, and in honor of Financial Literacy Month, they're really thinking about that. It's amazing how I'll say quasi-illiterate we are when it comes to being adults. But there are two things we're never taught in school. We talked about this a couple months ago, money and relationships. It's just not something that we're taught formally on. But I actually went to my friends, my very good friends, and I said, why aren't you working with a financial advisor? And then, of course, why aren't you working with me? And the answer was the same across the board. It's sort of what the industry got wrong in terms of how they message what financial advice or financial planning is. All of my friends said, well, you have to have a lot of money in order to work with an advisor, or you have to make a lot of money. So it's like, either have to be a millionaire to really deserve or be able to afford this thing. I have to make a bunch of money. It's really complicated, isn't it? Like, I don't need an estate plan because I don't have $10 million sitting around. So why do I need this? And then people said, it's actually hard. It feels so complicated. Like, I'm busy. We're married. We have kids. We have jobs. We want to go on vacation, post-COVID, all that kind of stuff. And I started thinking, that's what the industry tells you. And that's why at Facet, we want to change what this actually is. You don't, because I always tell people, all right, maybe you read all these stories about millionaires by the time they're 40 or 50, right? And now they're working with financial advisors. But what if they started that journey 10, 20 years ago before they had the wealth to help them make smarter, more informed decisions, right? Freedom from worry and power of choice in your financial life early on. It shouldn't be expensive. It shouldn't be complicated. You don't need a ton of money to work with an advisor. That's all changing, and Facet is proud to be leading that I'll say evolution within the industry.
I mean, it's so hard for people also, we've talked about this also, that money is, and these conversations are laden with the emotions, right? And
absolutely.
In terms of Financial Literacy Month, what are some of the core concepts that you think, besides the sort of the generalized financial planning, what are some of the other core concepts that you think people don't understand right now?
So, well, I can tell you right now, because we're in the middle of tax season, which just got extended a little bit here. Number one is I see a lot of questions. We probably get more questions, and this is seasonal, but we get a lot of questions, whether it's now, end of the year, around December, when people are talking about tax planning, charitable planning. We get a lot of questions around taxes. And so when I think about financial literacy, there's actually something I believe that most people miss. Because where's the first place most people start in financial literacy? Oh, it's budgeting. And we go, okay, how much are we spending? Now, I believe that's important. Don't get me wrong. That is a very important thing for a lot of people out there. But where we don't start? Most people don't even understand their earnings. I can tell you this. One of the biggest things, one of the first questions I ask my clients is, hey, how much do you make in a given year? Like, just ballpark it. And I get two answers most of the time. I'll use a number, right? I make $150,000 a year. Excellent. I go, is that base? Is that bonus? Is that equity compensation? And I usually get two answers. And one is like, I'm not sure. It's a combination and it fluctuates. I think that's about what I make. Or it's like, oh no, that's just my base. I'm not really sure what the other things are. And so when we think about budgeting, this is all downstream, right? We have to go to the source. A lot of our clients are thinking, okay, what is all like the bonuses and the commissions and equity compensation? So stock options that happen through your employer, that all matters. And then number two is, what are you paying in taxes?
Yeah.
I think I call it this like Vegas roulette game when we file our taxes. A lot of people are going, oh, am I going to get a refund? Or am I going to, what's the number? And I'm thinking, why are we waiting until we file our tax return to get the number back? Why aren't we doing proactive planning in the 12 months leading up to it? So we kind of know. You're never going to know exactly. I've never had a client get zero back, right, a refund or on their tax returns. But we try to get as close to that number as possible. Doing proactive planning around the income you're making, how all of it's taxed, when stock options vest or restricted stock units, which we're seeing a lot of these days, especially with the market blowing up in SPACs and IPOs. These are the fundamental things that then lead to how much you take home, your benefit elections. What decisions are you making around health insurance and 401ks and retirement plans and everything? All of that. I mean, 40%, maybe 50% of what you make is coming out before it hits your bank account.
It's so funny. I think that people really don't even understand the tax code. And, the number of questions that we field on this program that are directly related to, tax brackets, it leads me to believe that a lot of people don't understand that we have a progressive system. Like, when you make, it's almost like people are erroneously believing that as soon as they make $1 more, that puts them into the next tax bracket, that tax goes back to the first dollar. And they don't realize that, no, you're married filing jointly. So, if you make less than $81,000, that's your top bracket. But once you make, say, the next $20,000, that next $20,000 is taxed at 22%, not the whole amount of money you earn. So I think that even like the basic understanding of how the tax code, which is thorny and annoying, I get it, like how that works, I think we could go a long way into trying to help people out just doing that work and saying like, let's do that. What do you think about the idea that even if we taught financial literacy, even if it were a requirement in every high school, let's say, like you had to teach it as part of math, would people still make the same dopey mistakes? Because I remember seeing some research that indicated to me that even when people knew these concepts, they still screwed themselves.
So there's the missing link here is that I have this spectrum of like education to literacy to action, like to financial planning. So I think it's a really good point. Education is all about gathering data and information, right? That's what our school system is about. We're going to fill your brain with information. It doesn't actually teach you how to make smarter, more informed decisions. While I believe that we should teach all of this, the problem is you don't actually learn much of it until you actually have to go out there and make money and then spend money and save money. There's a program that we work with. It's down in Arizona, Tucson, Arizona. I think it's called the Third Decade Program. And what the gentleman that started this program said is like, he goes, forget about education in high school and college. You're not going to actually get anything across because we're not really using money every single day. So his approach is as soon as they graduate, then we're going to teach the fundamental tenets of financial literacy and the foundational, like the blocking and tackling of financial health, because then all of a sudden you're making money, you have benefit elections, you're looking at taxes. Then it starts to actually become more concrete.
We'll get back to our interview with Brent Weiss of Facet Wealth in just a moment. Maybe you've got some questions you'd like to ask Brent for the next time he's on the program, so shoot them to us. Our email address, askjill@jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are in the middle of our interview with Brent Weiss. We like to bring him on like once a month or so just to weigh in on what's going on at the street level. He is representing his company, Facet Wealth, facetwealth.com. Brent is a CFP there, and that's not an accident because Facet Wealth, they do financial planning for pretty much anyone who can get something out of that process. They do it with flat fee, conflict-free planning, and all that advice comes from a financial planner. So that's pretty great. So in this next part of our interview, oh boy, get ready. We're talking F word. What's the deal with fiduciary at this point? Like, where do we stand? I lost the thread, honest to God. Like, so fiduciary standard means, so everyone knows this because I drone on about this, but fiduciary standard means that your financial professional has to put you first ahead of his or her interest or the company's interest. And under the Obama administration, there was a move afoot to make anyone who kind of touched a retirement account a fiduciary or held to that fiduciary standard. Then the next president comes in and says, no, we're not doing that. And then there's this thing called best interest. So what is that? And how is that different than fiduciary?
What I've found is that the government and the IRS or whomever likes to make things really confusing. You just mentioned a minute ago why the tax code is so hard to understand. It's 2,500 pages, our tax code. By the way, I just did some research on this, so I know this number. And then there's 70,000 pages of written commentary on how to interpret those 2,500 pages. How are you going to get that? CPAs will always have a job because no one can get this right.
Right.
Now, how does that relate to this DOL, the best interest contract feature? The funny thing is I'm actually doing research on this myself because I'm writing a blog post, an opinion piece around what I believe this to be. You want to talk about confusing. This is like the man on the street kind of thing. If you went out there, or a person on the street, if you went out there and asked anybody, let me ask you a question. What's the difference between someone who has to act in your best interest or has to be a fiduciary, which means they have to act in your best interest? People are going to go, huh? What's the difference?
I just did that. As you said that, say it again. Let me let that process.
Okay.
Say it again.
So there's two standards of care that the industry says exist. One is the best interest standard. Okay.
Right.
The other is the fiduciary standard. So the best interest standard says someone has to act in your best interest. The fiduciary standard says someone has to act in your best interest. What's the difference?
What is the difference?
Well, so here it is. There's a lot here, so I'm going to try to keep it simple, and then I'll share with you my thought on this. The best interest simply means someone has to take your best interest into consideration at the point of sale, meaning during the transaction. So if I recommend to someone, hey, roll your 401k over to Facet because we have an IRA or a Roth or whatever it is here, that would have to fall under the best interest standard. Any other bit of advice I give you, if you called me and asked about a mortgage, a car purchase, whatever it is, wouldn't fall into a fiduciary or best interest standard. It's the point of the transaction or the sale. Now, fiduciary says, and you can go to the CFP board website and you'll see all of this, like duty of care, duty of loyalty. Every single interaction I have with one of my clients, whether it involves, I'm going to say a sale, we don't sell anything. That's why we charge a flat fee, because I never want to have to be in a position where I'm selling anything to my clients. We're just giving unbiased advice for a flat fee. But anytime I'm giving advice or talking about their finances, I'm held to the fiduciary standard. Should you pay down your mortgage or invest? Right? How should you think about sending your son or daughter to school? That all falls under my obligation as a CFP professional to act in your best interest, not at a transactional moment in your life. And that's the primary difference as I see it.
That's so interesting. So you're saying, let's make this like a clear case. I go see my broker at Joe's big wirehouse, right?
Mm-hmm.
And I say, hey, broker Joe, I'm wondering, I have $500 extra every month.
Mm-hmm.
Joe, I have, what should I do with that? Now, if Joe says you should put this in a Roth IRA account for me, do you have to first say, does Joe have to say, well, how are you maxing out your 401k? In other words, I'm wondering, like, really in that moment, because that's a transaction, right? So
absolutely.
I would put money into a Roth IRA. Should I put that into a Roth IRA? Or maybe if I have a Roth 401k at work and I'm not maxing that out, that's actually the better choice for me. So is Wirehouse Joe on the hook for telling me that I should, because it's probably in my better or best interest to max out my Roth 401k at work? Is that how you would understand it or not?
So here's the kicker. Here's the other thing we have to add, the other element to this cocktail. Is that individual, is Joe in this case, legally giving you investment advice? Now, investment advice has its own definition. Typically, it includes for compensation. So it says XYZ for compensation. So if Joe says, you should put that $500 in a Roth IRA with me, then that qualifies as investment advice. Therefore, it's a transaction that's covered by best interest.
Okay.
Now, he could say, go put it over at some other, brokerage firm and open the Roth, or, hey, put in your Roth 401k. If it's not for advice or for compensation, then it may not follow. But here's the thing. If Joe's already managing money for you, and I disagree with the assets under management model, we can debate that on a follow-up conversation where they're charging you based upon how much money they're managing. That's not what we do at Facet, right? We're a flat fee. I don't care how much money you have. We're not going to charge you more for it. You keep it. But that relationship in and of itself, when Joe's giving you advice, should fall under best interest. Okay. Now, this is a very nuanced area, because the bottom line is this. Joe should be asking, frankly, but what about your debt? Do you have high interest rate debt? Right? Are you getting your full employer match? Because if you're not, right, that is free money. That's the only way I know to double your money overnight, is to make sure you're getting your employer match. And then we go down this sort of checklist of decisions. Okay, you're already doing that. No bad debt. You're getting your employer match. This is great. Okay, now maybe the Roth 401k or the Roth IRA makes sense. These are all things that should be considered. Here's my opinion on this, and I strongly believe this. I actually think, because we have a list, we help even before people become clients, we educate them on the landscape in the industry, like what advisors are, the standard of care, the standard of expertise and knowledge. One of the questions that we typically have them ask is, of an advisor, are you a fiduciary? My opinion on this is, I actually believe it's the wrong question to ask, because in my opinion, being a fiduciary, doing what is best and right for your clients at all times, that's table stakes. That should be table stakes in this industry. That's why I believe the right question is, are you a CFP professional? And if someone says no, then in my opinion, for people that are looking for truly integrated and comprehensive planning, they're not going to be a good solution for you. Because here's what I can share with you. A CFP professional, by the very nature of having that designation, has to be a fiduciary 24/7, regardless of what they're doing.
By the way, not the way it always was.
Correct.
Right? Because that's a new-ish development for CFP professionals, because it used to be actually was sort of similar to the way that I'm understanding the way you explained best interest, meaning that it used to be that if you're if there's a transaction, then you do. But now it's a blanket statement. CFP professionals, and I think CPAs also who have that PFS designation,
Right.
and anyone who is a member of NAPFA, that these are the kinds of financial professionals that all the time have to put your best interest first. They have to really say, this is the smartest thing for you to do, client, right?
Yeah, so you make a good point, right? I'm not cutting out CPAs and CFAs and educated, experienced professionals, because that would be incorrect. I'm sort of saying specifically when it comes to financial advice or financial planning, CFP professional, in my opinion, is the standard. There's a whole mess here. It is wildly confusing. Just like the tax code that's like 2,500 pages long. This is probably like 2,000 pages long.
Yeah, it's so annoying to me that there's not a single standard of care. I really think that this does such a disservice to the individuals out there listening. For those of you who are hearing this, you're working with some sort of financial person, okay? This could be somebody that you talk to at the bank. It could be somebody who is a stockbroker, used to be a stockbroker and now calls him or herself a financial consultant or advisor. But I think that what you're saying, Brent, is that there's two aspects. There's sort of like the letter of the law and the rules, which are evolving in the right direction. So no doubt. But you're also saying be aware of what this person is doing for you. We'll get back to our interview with Brent Weiss in just a moment. Hey, during the break, here is something fun you can do. You can go onto our website and you can check out the watch, listen, read, or resource sections. It's a vast trove of content. Mark makes sure of it. So check it out. Jill on Money, JillOnMoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You are back. It is Jill on Money. And this is the program that attempts to demystify your whole financial life. Take the mystery out of all these different things. So much going on right now. I think a lot of people are still in the process of filing their taxes. I don't know about you, but that whole delayed filing, I mean, I guess I understand it, but it sort of delays the inevitable. And frankly, for so many people, if you have to pay your quarterly taxes anyway, you kind of had to get done. So if you are in the midst of filing those taxes, if you have not gotten on the ball, please get going. Come on now. 85% of people get refunds. So we want to make sure that you get your money and get going. So there's that. All right. Now, we just finished a segment talking about the Fiduciary Standard and financial advice. We are now going back to our interview with Brent Weiss. He is the chief evangelist and a certified financial planner at Facet Wealth. And in this part of the interview, we are really trying to isolate what questions you need to ask a financial professional before you engage him or her. Here's more of our interview with Brent Weiss. So if you were going to ask 3 important questions of the community at large, of like the financial professional community, and you're working with somebody, what are the 3 questions you think that individuals listening to this right now should be asking?
I have 10 questions I typically have.
Come on, so do I. Big deal.
I'm going to distill it down to 3. And here's
Give us 3 questions. Number 1.
So first of all, the first thing you need to be asking is, what are your qualifications? Okay, because this is where you want to start vetting. Are they at the right standard of education, expertise, and knowledge when it comes to being able to do a good job for you? Okay. So they say, okay, I am a CPA, I'm a CFA, I'm a CFP professional. Okay. We can play ball. If they're not in that level or at that level, in my opinion, you should be searching for somebody else. Because here's the thing, anyone that has those higher level certifications has to go through rigorous education. Yep. Right? There's experience requirements, almost like a mini residency, like when people become a doctor. Like they've actually had to go through some of this before. There's expertise and professionalism plus a fiduciary standard. Number 2 is, I would say, who do you work with? Like, what clients do you work with? Because they come back and so let's say I'm pushing 40, right? But I'm a business owner. And someone comes back and says, I work primarily with people who are retiring. I'm going to go, they don't know my situation. They didn't say business owner. They didn't say someone who is about to start a family. I want to know that somebody understands my situation and works with people like me all day long. The third question is, I'm going to fold two in here. I'm going to cheat a little bit here, Jill, is how do you charge and what services do you provide for that fee? Mm-hmm. And what we're looking for, are they going to say, the old stockbroker thing, I charge commissions, I charge based upon the assets I manage, percentage of assets, or I charge a flat fee. And for that, here's what I do for you. Is it just investment management? Maybe that's what you're looking for. I'm not here to tell you what's right or wrong in your financial life. Maybe that's just what you need because you manage your own finances on the side. Totally cool. But really understand, what are they going to give you for the fee they're charging? In my opinion, this is my opinion, I strongly believe this, it should be based upon a flat fee for the services rendered and your needs in that financial relationship. That better aligns the cost you're paying, your price to pay, and the value that that individual is providing to you. The percentage of assets model, I won't go too deep there. I think that's a little broken just because it means, first of all, it eliminates access for so many people out there, right? So many people are starting their wealth building journey and saying, I don't have $1 million yet. What do I do? Well, find someone who charges a flat fee. We do that at Facet to help you start your journey. Those are the three questions I would ask primarily. There are some more nuanced things out there. If you ask those three questions, by the way, I always, even people when they come to Facet, I say, do me a favor, shop around. I want to make sure that when you make this decision, that you feel comfortable about it and you go, this is the right place for me.
The three questions, is everyone listening? What are your qualifications? Who do you work with? And by the way, don't say, I'm a small business owner. Do you work with small business owners? Because, all these jamokes are going to be like, yeah, of course I do.
Good point.
So open-ended, how do you charge and what services do you provide? Can I just do a little my little editorial on that? I don't think anybody should be paying any fees for asset management that are more than 0.3%. And here's why. Because if that's all you're getting, which is like, put this portfolio through a computer program and spit out an allocation, like you can get that anywhere. You don't have to go to a human being to get that. But if you do want comprehensive advice, then you really need to figure out what is it that this person's doing. And is it like a 300-page MBA analysis of your life that's going to be like essentially worthless to you? Or is it, is it a usable, actionable plan? That's what I think. And then finally, I'm wondering, what do you think of the idea of people getting referrals? I've been used as a referral to some folks in the business. It's like people say to me, oh, can you give, but then sometimes I think it's sort of silly because like, what's the advisor going to do? Tell you to go to somebody who's not happy? So what's your opinion about that?
Here's the thing. If we think about going back in time to the beginning of this conversation today, we talked a lot about emotions. Talking about money is a very emotional thing. When you sit down with somebody, you need to trust him or her in that relationship. Well, how do you build trust sort of immediately? Well, you trust somebody and they make an introduction or referral to someone they know and they trust. You go, okay, I know that Brent really likes this CPA or this estate planning attorney, or frankly, someone just for insurance. I'm going to go because I know Brent referred me because I already trust Brent. So I love referrals. I think it's one of the, I'm going to go meet with an estate planning attorney from a referral of a friend of mine who's an attorney in Maryland, doesn't work in Florida. I'm going to start there. I'm also going to interview somebody else. The thing you need to ask is, are they receiving any kind of compensation for that relationship or that partnership? Because people do pay referral fees, meaning I refer somebody, if someone were to refer you out to another professional, there may be some kind, I'll call it a kickback that makes it sound overly negative, but there may be some financial relationship. So ask it. By the way, that doesn't make it a bad relationship because that could mean that person's fantastic and there's just a relationship they have as companies, organizations, professionals. But ask that question. Are they getting any kind of compensation? It could be financial, non-financial, for making that introduction. Don't say no if they are. If the answer is yes, don't say no immediately. Just dig in and like, what is that? Why are you referring it? And are they, at the end of the day, here's the bottom line. Are they the right professional for you? Do they have the certification or qualifications? Are they charging appropriately? And can they give you personalized advice for your financial life? If all those three things are true, the compensation arrangement doesn't really matter, but make sure you understand going into it. And that should be fully disclosed. By the way, a fiduciary will always disclose any conflict of interest in the relationship.
Okay, we'll get back to the conclusion of our interview with our guest, Brent Weiss, in just a second. During the break, here's what you're going to do. You're going to go to JillOnMoney.com and just bookmark it. Bookmark it. That way, anytime you want to find us, you go right there and you can hit the contact button if you've got a question. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. And this is the show that attempts to take the mystery out of your financial life. And we do that by answering your financial questions. Now, if you missed any part of this show, you can go back and you can listen to it on our website, jillonmoney.com. We also have a YouTube channel. Mark, how's that YouTube channel doing? Pretty well? Do we sometimes get mean comments? Why do people do that? Oh, you changed that because I was getting my hurt feelings? I really did. I don't know. I have a very thin skin, don't I? Anyway, does that surprise you, Mark? But before you knew that about me, wasn't it surprising when you found out what a thin skin I had? I'm a baby. I like the adulation of the public. I don't like the criticism. Listen, I like a criticism if it's real constructive. If it's just plain old mean, no thank you. I don't need mean. But if it's constructive or you take a different point of view, I'm fine with that, right? So anyway, we have this YouTube channel. We've got a lot of other stuff. We've got a YouTube channel. One other thing that we haven't talked about is we actually have a social presence. We have a Twitter account called @JillOnMoney. What else do I have? Instagram. Anything else? Facebook page, I guess I have. Do we do anything on Facebook anymore? Is anyone looking for me? Mark sometimes has to tell me like, oh, your uncle needs to find you or something like that. LinkedIn. Oh, yeah, we got a big, how's our LinkedIn? Man, I got to check that out. My sister always says to me, you got to go on LinkedIn. And I said, hang on, I got to get my password from Mark. Anyway, we post stuff all over the place. We want to meet you where you are. Here's where I'm not. I'm not in Clubhouse. And I think I'm going to avoid that completely. I think I have no interest in that. Oh, boy. Yeah. You know, it's, you'll look it up after the show. It's unnecessary for you to know what it is. That's what I can tell you. Truly, it's not. It is completely unnecessary for you to know right now. But anyway, it's a way to basically have audio conversations in separate rooms. Like, so I would have like my own little room in Clubhouse with Jill on Money followers, which sounds all well and good. And there's comments, there's a free flow of conversation, with one huge downside, which is I'm not exactly sure how you monetize that. So I'd love to all hang out with you guys. It's great, but I got to make a few shekels to make it worth my while. Agreed? Anyway, let's get back to our conversation with Brent Weiss. He is the chief evangelist, and he is a financial planner and a certified financial planner at Facet Wealth. Every month he comes on to tell us kind of like what's going on in the world of financial planning. And he gives us an update on his, what we call the 1% pledge, meaning how he tries to make his life 1% better. So, you know, he did his non-deductible IRA and he opened up a traditional brokerage account. What is his 1% pledge this month? Here's more of our interview with Brent Weiss. So let's talk about your pledge, your 1% pledge. Now we started with, what was your first pledge? Was it saving an extra percent? Is that what happened for you?
Well, yeah, it was a couple of things. First of all, it was establishing, and we talked about this too, the non-deductible Roth IRA with the Roth IRA.
Right, because we were worried that you were only making a certain amount of money, and we were concerned that you weren't making enough money. Okay, so it was a non-deductible IRA. That was number one. Right,
and then I opened up a traditional taxable brokerage account and started funding that with just 1% of my pay. I did an ESG, so environmental government or social governance portfolio to balance out the rest of my overall portfolio. That was my 1% pledge.
To assuage your guilt.
Yeah, I know. I'm now investing 1% of my money in hopefully things that'll eventually solve climate change. I don't know if it actually will, but
exactly.
I can sleep at night now, John.
I'm getting into my my 4-wheel drive car but right as I make that decision.
Yeah, I'm getting in my gas guzzling Mercedes, but I am putting 1% of my money towards sustainable investing.
Okay.
All right. And so for those that listened back in January, I just moved to Florida and changed my residency. Here's one thing I know as a financial planner. When you change your state of residency, you have to go through the incredibly thrilling process of updating your estate planning documents. And so I'm finally getting my act together. Because by the way, I've had clients that would for years not do their estate planning documents because they don't make it easy. I'm finally getting my butt in gear this month, and I'm going to execute new estate planning documents. So will, financial power of attorney, durable healthcare power of attorney, all that really exciting stuff that I'm sure your entire audience wants to learn all about. I'm going to get that done this month because I have to, right? This is a way for me to protect myself from financial matters, healthcare matters, to protect my family, and ultimately, since I'm a business owner, to protect my business and my business partners. And that's really, really important. So my 1% pledge, this is going to feel like a 10% pledge because it's a bear of a project and not always fun, but I know how critically important it is to me, the things I've worked hard for, and the people that I love. And I'm going to go execute my estate planning documents.
I like that. I'm wholeheartedly in favor of that. I'm going to tell you what. Hey, Mark, you know what it sounds like to me? It sounds like this guy might be thinking about getting married. What do you think? That's what I think. I'm reading between the lines there. I don't know if she's listening, but I'm just telling you right now that that's what I'm hearing.
Her mother listens every single month. She loves this show. I'm not going to say anything. We're going to see what happens if her mother contacts her and I get a if I'm woken up in the morning to a text from her mom, I'm going to know where she heard it.
Your future mother-in-law is going to want to know. Anyway, that's what I smell. All right. Thanks to Brent Weiss for joining us again. He'll be back next month. I think we'll talk about education funding next month. It is May and 529 day. Get it? May 29th. If you've got education related or financing questions for Brent, just send an email to us. Ask Jill at jillonmoney.com, and we'll be right back. You're back. It's Jill on Money. And before we conclude our program today, we are going to take one more question. Remember, if you've got a financial question, 2 ways to get in touch with us. You can send an email, ask Jill at jillonmoney.com. Or if you are on our website, which is jillonmoney.com, there's a contact button. Just hit it and ask the question. And if you'd like to join us on the program, we'd love to have you. Just let us know, and Mark will do the rest. Okay, Jim writes that he enjoys listening to us on the radio. He says, I am 82 and semi-retired. Gotta love this guy. He's only semi-retired at 82. He says, I've got a good pension plus Social Security and income from consulting. I'm risk averse, and over the years, I've placed nearly $400,000 in a money market account. At one time, it received a fair interest rate, but now 0.15%. What safe options do I have in this market to earn more? You know, this is the problem with a low interest rate environment, that you just don't get a ton of money. What you can do, Jim, is you can go to depositaccounts.com and you can compare all the different rates that are out there, whether it's for savings or CD or checking or money market. I just happen to pop on there and I'm looking and seeing like, oh, what money markets have and where are they? And some of these are like weird banks you may not have heard of, but it does look like you can probably get some more money in terms of earnings. There are some higher yielding savings accounts. I see here, here's our old friends at Marcus. Remember Marcus, Mark? It was pretty amazing. Marcus used to be our sponsor, and now look what they got. Marcus account is yielding 0.5 percentage point. Now, that is not a lot of money, but that is 0.5 percentage point is better than 0.15. So that's just one option. So I think as long as you know that it's a risk, you want a very, very low risk, the best place to go to look for higher rates would be depositaccounts.com. I hope that helps. Let us know. All right, that's it. That's for the program. And we thank you so much for listening. Our music is composed by Joel Goodman. Mark Talercio is our executive producer. And as always, we want to remind you to wash your hands, to wear your masks, to maintain your physical distancing, and do something nice for someone else today. Thanks for listening. We'll talk to you next week.